Have you noticed that your grocery bill seems higher than last year, even though you're buying the same things? Or maybe you've seen headlines about inflation but aren't exactly sure what it means for you. Inflation is one of those financial concepts that impacts all of us every single day, whether we realize it or not. And at its core, it's simply the rise in prices over time, which means the value of money decreases because the same dollar buys you less than it did before. Imagine going to the store with $20 10 years ago that might have been enough for a full bag of groceries. But today, you might walk out with only a few items, and that's inflation at work. I'm curious. What's the first item you've noticed really jump in price lately? For some people, it's eggs. For others, it's gas. And it's always interesting to see what hits home first. There are a few main drivers of inflation. The first is demand pull inflation, which happens when demand for goods and services is higher than the available supply, like when everyone wants to buy new cars, but there aren't enough cars being produced, so prices go up. The second is cost push inflation, which occurs when it costs more to produce goods. For example, if wages rise or the price of oil goes up, making transportation more expensive, companies pass those costs on to consumers. Finally, there's built-in inflation, which happens when workers expect their wages to rise over time to keep up with the cost of living, and businesses raise prices to cover those higher wages, creating a cycle where wages go up and then prices go up as well. So how do we actually measure inflation? One of the most common tools is the Consumer Price Index, or CPI, which tracks the prices of a basket of everyday goods and services like food, gas, housing, and healthcare. When the average cost of that basket rises, it signals inflation. If the CPI reports that inflation is 3% this year, it means that on average prices have increased by 3% compared to last year. And while that may not sound like much, even small percentages add up over time because a 3% increase year after year compounds. And in a decade, prices could be nearly a third higher than today. There are other measures too, like the Producer Price Index, which tracks what businesses are paying for materials and goods. Sometimes producer prices rise before consumer prices, giving us a preview of what's coming down the pipeline. Inflation doesn't just hit groceries and gas. It shows up in utilities like electricity and heating bills that creep up season after season. It shows up in streaming services and subscription plans that announce new price hikes every year. Healthcare and education are two areas where inflation often runs higher than the national average, meaning the cost of college or medical care rises even faster than most other things. That's why many families feel squeezed, even when inflation reports sound modest. The impact on you is clear. Inflation reduces your purchasing power. If your income stays the same while prices rise, you can afford less over time. For example, if you earn $50,000 a year and prices rise 5%, you'd need $52,500 next year just to buy the same things you did this year. And without a raise, you're effectively earning less. This is why inflation is often called a hidden tax. Your money loses value simply by sitting still. But not everyone loses. Borrowers often benefit during inflation because if you took out a fixed-rate loan like a mortgage, your payment stays the same even as wages and prices rise, which means you're paying back your loan with money that's worth less. On the other hand, savers usually lose because if your money is sitting in a savings account earning very little interest, inflation slowly eats away at its value. And here's something worth thinking about. Do you feel like you've been more affected by inflation as a saver, watching your money lose value, or as a spender, seeing your costs jump? So who tries to keep this under control? In the US, the Federal Reserve plays a major role by using tools like raising or lowering interest rates. If inflation is too high, the Fed raises rates, making borrowing more expensive, slowing down spending, and cooling off rising prices. If inflation is too low, they lower rates to encourage borrowing and spending. The goal is balance, because too much inflation hurts consumers, but too little inflation can signal a weak economy. In fact, deflation, when prices actually fall, can be just as dangerous because it often leads to businesses cutting wages, reducing jobs, and slowing the economy further. That's why the Fed generally aims for about 2% inflation per year as healthy and sustainable. You see the effects of inflation everywhere, in the cost of housing, your morning coffee, airline tickets, tuition, and even movie tickets. It influences not just your wallet, but your choices, like whether you can afford a vacation, buy a house, or retire comfortably. For families, it can mean adjusting budgets month to month, cutting back on dining out, or delaying big purchases. For retirees, it's even tougher because they're often living on fixed incomes that don't keep up with rising prices. Inflation isn't just an economic number. It's something you feel in the checkout line, at the gas pump, and when opening bills. And it's not only the US inflation plays out differently around the world. Some countries experience hyperinflation, where prices spiral out of control, like Zimbabwe in the late 2000s or Venezuela more recently. In those situations, a loaf of bread might cost thousands or even millions of local currency units. On the flip side, some countries with stronger or more stable currencies may experience lower inflation but still feel its effects through imports and trade. Since we live in a global economy, what happens with inflation in one part of the world can affect prices everywhere else. So how do you protect yourself? First, invest your money instead of letting it sit idle. Historically, assets like stocks, real estate, and even commodities like gold tend to outpace inflation over the long run. Second, look for inflation-protected investments, such as Treasury inflation-protected securities, or TIPS, which are designed to rise with inflation. Third, grow your income by negotiating raises, developing new skills, or creating side hustles to stay ahead of rising costs. Fourth, budget smartly. Tracking your spending and cutting unnecessary expenses can help offset the impact of higher prices. And finally, diversify. Having your money spread across different types of assets means you're not overly exposed to any single area that inflation might hit the hardest. Even simple steps like paying off high-interest debt sooner or building an emergency fund help shield you when inflation pushes daily costs higher. Looking back at history gives us perspective. In the 1970s, the US experienced very high inflation, sometimes over 10% a year, which made everyday goods unaffordable and created instability. By contrast, in the 2010s, inflation was relatively low, but that came with its own challenges like slow wage growth. Even further back, during the Great Depression, the US actually experienced deflation, where prices fell sharply, but that wasn't good news either, because wages dropped and unemployment skyrocketed. The lesson here is that while inflation can feel painful, a complete lack of it isn't healthy either. A small, steady amount helps keep the economy moving. So to recap, inflation is the rise in prices over time, caused by demand, production costs, and wage cycles. It reduces your purchasing power and impacts everything from groceries to retirement, but understanding it gives you the power to adapt. By investing, increasing your income, budgeting wisely, and diversifying your money, you can stay ahead of inflation and even turn it into an opportunity. At the end of the day, inflation touches every dollar you earn and spend, and the more you understand it, the better prepared you'll be to protect your financial future.